So I tried Forex trading so you don't have to. And honestly, I was not ready for what happened. And I always used to see videos online, people making money from their phones, showing profits, luxury lifestyles, and claiming they turn small accounts to thousands of dollars. So I asked myself one simple question. Is Forex trading actually real, or is it just hype? And to find out, I decided to do something simple but risky. I started forex trading with a small amount of money, no experience, no mentor, just YouTube videos and a trading app. And in this video, I'm going to show you exactly what happened step by step, including the mistakes I made, the losses, and the surprising things I learned. So stick to the end because what I discovered about Forex might completely change how you see it. So before you get started, I ask you to kindly support my channel by hitting the like button, liking this video, and also subscribing to my channel. So let's get started. Before I started, I thought Forex was simple. Buy low, sell high, make money. That's what I believed. I also thought people were making money every single day just by predicting whether a currency would go up or down. But I quickly realized something important. Forex is not just clicking buy and sell, it's it's a global market where currencies are constantly moving, and those movements are influenced by many things like news, economies, interest rates, and global events. Still, I wanted to try it myself, so I downloaded a trading app and deposited a small amount, just enough that I wouldn't feel too bad if I lost it. My goal wasn't to get rich. My goal was simple: to learn what really happens when someone starts forex trading. So before we proceed, let me introduce you to forex trading. So what is forex trading? Forex stands for foreign exchange, and it simply means exchanging one currency for another. Think about it like this: if you travel from Kenya to the US, you exchange Kenyan shillings for US dollars. That's forex. But in trading, you are not just exchanging, you are speculating. You are trying to predict whether one currency will rise or fall against another. Currencies are traded in pairs. For example, we have euro versus US dollar, we have British pound versus US dollar, we have US dollar versus Japanese yen. There are many pairs. And if you believe the euro will get stronger compared to the dollar, you buy euro versus the US dollar. If you believe it will weaken, you sell. And that's the core idea of forex trading. So now let's go a bit deeper into how it actually works. In forex trading, you make money from price movements. Prices move in small units called pips. For example, if euro versus USD moves from 1.1000 to 1.1010, that's a 10 pip movement. The more pips the market moves in your direction, the more profit you make. Next is something called lot size, which determines how much you're trading. There is standard lot, which is 100,000 units. There is mini lot, which is 10,000 units, and micro lot, which is 1,000 units. As a beginner, you are likely to start with micro or mini lot. Now, here where things get interesting: leverage. Leverage allows you to control a large amount of money with a small deposit. For example, with a 1 to 100 leverage, you can control $1,000 with just $10. Sounds amazing, right? But here the catch: leverage increases both profits and losses. This is why many beginners blow their accounts quickly. So let's go back to my experience as a beginner. The moment I opened the trading app for the first time, I got confused. charts everywhere, candles moving up and down, numbers changing every second. I failed or I never understood anything, but I did what most beginners do. I clicked buy. No strategy, no analysis, just guessing. And within minutes, the market moved against me, and I saw my first small loss. At that moment, I thought, okay, maybe I just picked the wrong time. So I tried again. Another trade, same result, loss again. And that's when I realized something dangerous. Forex looks easy, but without knowledge, it's basically gambling. Another day, I made a classical beginner mistake, and this time I tried to recover my losses immediately. Instead of stopping, I increased my trade size. This is called revenge trading, and it's one of the fastest ways many traders or many people lose money in forex. I remember thinking I just need one good trade to recover everything, but instead I lost again. At this point, I wasn't just losing money, I was losing control. So I stopped everything and took a break. After losing money, I realized something. I wasn't trading, I was guessing. No strategy, no system, just vibes. So I did something most beginners avoid. I stepped back and actually learned the basics. And that's when things started to click. First, I understood what Forex trading really is. It's the buying and selling of currencies, as I said earlier. And always, currencies are traded in pairs, like the euro versus USD, there is British pound versus US dollar, there is US dollar versus Japanese yen. But here is what most people don't tell you. Not all currency pairs behave the same. You have major pairs like euro versus USD, and these are the most traded, most stable, and usually have lower spreads. Then there are minor pairs like euro versus Great Britain pound, and these still liquid but less popular. And finally, we have exotic pairs like USD versus South African rand, and these can move wildly and are much riskier. As a beginner, I learned the hard way: stick to the majors. Now, once I understood the pairs, the next step is direction. In forex, you always asking one question: is this currency going up or down? If you think price will go up, you buy. If you think price will go down, you sell. Simple in theory, but in reality, that's where most people fail, because the real skill is not prediction, it's understanding why the market moves. That's when I discovered two powerful approaches: fundamental analysis and technical analysis. So let's start with fundamental analysis. This is all about the bigger picture. You look at things like interest rates, inflation, economic news, government policies. For example, if the US economy is strong, the US dollar tends to rise. If inflation is high, currencies can weaken, and big news events, they can shake market instantly. This is why traders pay attention to things like central bank decisions and major economic reports. Then there is technical analysis. This is where charts come in. Instead of news, we focus on price movement or price itself. So you study patterns, trends, and key levels, things like support and resistance, trend lines, candlestick patterns, and most importantly, you learn to identify market direction, because markets don't just move randomly, they move in trends. There is uptrends, there is downtrends, and sideways markets. And here is the moment everything changed for me. Once I stopped trying to guess and started following trends, things finally started to make sense. Not perfect, but clearer. And that's when I realized Forex isn't about being right all the time. It's about being disciplined, patient, and actually knowing what you're doing. So now let's talk about a simple strategy you can start using today as a beginner. It's one of the strategies that I discovered. This is called trading. It's one of the easiest and most effective strategies for beginners. It involves several steps. In step 1, you identify the trend. Look at the chart and check whether the market is going up, down, or sideways. And in step 2, you use moving averages. Add 2 indicators to your chart. That's 50 period moving average and 200 period moving average. Then if price is above both lines, look for opportunities to buy. If price is below, look for sell opportunities. Step 3, wait for confirmation. Don't rush into trades. Wait for price to pull back and continue in the trend direction. This strategy keeps things simple and helps you trade with the market, not against it. So to the next section, why most beginners fail. Let's be honest for a moment. Forex is not easy money. In fact, most beginners fail, and here is why, based on my experience. First, they don't learn. Second, they don't have strategy. People jump into trading without understanding the market. They rely on random signals or guesswork. Second, over trading. They take too many trades hoping to get rich quickly. Third, over leveraging. Using too much leverage can wipe out your account in minutes. And finally, emotions. Fear and greed control decisions, leading to bad trades. Successful trading is not about luck, it's about discipline, patience, and consistency. Another one is lack of risk management. Risk management is the most important part of trading, and if you ignore this, nothing else matters. Risk management is what keeps you in the game. Rule number 1, never risk more than 1 to 2% of your account on a single trade. For example, if you have 100,000 or $100, only risk $1 to $2 per trade. Rule number 2, always use a stop loss. A stop loss automatically closes your trade if the market moves against you. Rule number 3, don't chase losses. If you lose a trade, accept it and move on. And trying to recover losses quickly often leads to bigger losses. Professional traders don't win every trade, but they manage their risk so they stay profitable over time. So would I recommend Forex trading? Yes, but only if you treat it like a skill, not a gamble. Forex can be powerful, but only if you respect it. If you ignore the rules, it will punish you quickly. If you learn it properly, it can become a valuable financial skill. And here is my advice. Number 1, don't rush into live trading. Number 2, learn before risking real money or your real money. Number 3, start with the demo account first. Number 4, never trade emotionally. Number 5, and finally, risk management is everything. Most beginners ignore these rules, and that's why most beginners lose. And if you enjoyed this video, please like, subscribe, and share your thoughts in the comments section. And thanks for watching, and I will see you in the next one.